Hey, my name is Tucker Kraus, and welcome back to my channel. In today's video, we're going to be taking a look at DYL. Yes, I'm finally back. Hopefully, I can be a bit more consistent. I know, I'm trying my best here. I've got a part-time job, and, I'm trying to graduate 2 years ago. All that stuff, a little bit time-consuming. Along with, researching the entire company and all that. It takes a bit of time, but that's not too important. Let's get right into the video. Today, we're going to be looking at DYL. I wanted to look at these guys for a long time, so let's see how they look. Alright, so DYL trades with the ticker DYL on the ASX or DYLLF on over-the-counter exchanges in the USA at 69 cents American per share or 90 cents Australian per share, with a market cap of 350 million Australian or 267 million USD, with a $1.77 USD per pound or 232 Australian dollars per pound. So on the price per pound, definitely looks really good here, 177. That's pretty solid right here. I definitely like at least below the $2 range at this point. A lot of them are well above the $1 range at this point. You don't see too many below $1 anymore, but you know what? This is still very respectable. So over here, tucked up in just the top right over here is the max chart. As you can see, it's essentially worthless, but in the last 5 years, of course, like the rest of the uranium stocks, most of these stocks seem to follow a similar pattern, of course, being in the, same sector and all, right? Has definitely come up a whole bunch just in the last year or two, and in the last 6 months, definitely since that mid-September massive run-up with SPUT has pulled back a decent amount, and we seem to be consolidating lower to sideways overall. So just going through a few slides from their presentation here. So they want to establish 5 to 10 million pounds of production per annum, and being a tier 1 uranium producer and all that, with their projects being all located in Namibia, which is, of course, in my opinion and many others, the best uranium mining jurisdiction globally, and so significant progression and growth of their project. And they do have a DFS progressing as planned. I believe that's supposed to come out in late 2022. We are currently going to be working with a pre-feasibility study for the purposes of this video. And of course, led out by a standout and proven uranium team. Of course, a lot of them being formerly of Paladin Energy and growing, Paladin with that 1000x and all that good stuff. And they currently have a cash balance of Australian dollars 73 million, and nuclear energy becoming the moral and variable positive momentum building globally. Of course, if you know the uranium thesis, you know that last part. So, their share structure. This is really solid. A lot of these Australian companies have fairly poor share structure, at least in shares on issue, or shares outstanding, whatever you like to say. Most of these companies will have 1 to 2 billion of shares outstanding, but these guys, DBL, is still looking really good here. Only 381 million shares outstanding. So, I would say it's very solid, not to mention that near 11% board/management, so insider shareholder, is really, really high. That's great to see. I love that. And we got some other major people like Sprott also invested in them. Now we see for the management, of course, John Borshoff as the CEO, of course, with his fame from Paladin, and honestly, probably his interviews are some of my favorite to watch on Crux, in my opinion. Well, I think I said in my opinion twice there. I'm not sure. I'll figure it out when I edit, I guess. But let's keep moving. Alright, so Namibia, tier 1 uranium mining jurisdiction, responsible for 6% of global uranium output, and of course, lots of large capacity, long life mining operations have been established in Namibia, and project situation within the highly prospective uranium provinces, DBL's projects, with nearly 2 billion pounds of uranium here. And Namibia offers excellent infrastructure for developing mining, like you probably already know. So let's get into an overview of their project. So they've got 150 million pounds in the ground, so very large deposit here. That's what you like to see, because I like a lot of the company with the very large deposits rather than with a bunch of small scattered ones, because chances are a company would rather go and just purchase uranium just from one big mine than a whole bunch of little ones. So they also have a 3% royalty on here at a low grade of 248 parts per million, with a somewhat high initial capex of $295 million, though of course a lot of pounds in the ground, so makes up for it with 357.4 million in total capex. Now they'll have an OPEX of $27.28 per pound. They expect to be constructing the mine for 1.5 years, so very quick. That's good to see, and producing for 11.5. Something I should note though, of this 150 million pounds in the ground, this is only going to be producing 21 29.1 million pounds of uranium, so there's going to be a whole lot of extra uranium in the ground here, similar to Global Atomic's plans. And being in Namibia, 37.5% corporate tax rate, and like I said earlier, based on the PFS and the DFS, which will be, of course, more accurate, is scheduled for late 2022. So with that, I'll assume the DCF, the construction will begin in 2024. And just because they have a couple exploration projects, here's the total, 196 million pounds total at a also low grade of 273 parts per million. So we can see 150 million, 196. So of course the majority of it is in their big development project. So let's move on to their fair value with the DCF here. So for the most part, they actually look fairly overvalued. As we can see, not even profitable at current or even $60 uranium prices, though of course that's with the 50% capex and OPEX inflation and 10% discount rate and all that. So of course that doesn't help, since of course that 50% inflation is not realistic. It's obviously going to be a lot higher, or sorry, not a lot higher, sorry. There's not going to be, the inflation will be far lower on at least the capex and OPEX here. You know, their prices might be 10 to 20% higher, their costs, than, you know, maybe they plan, something like that. That's what I think is a lot more realistic. And so I think the best way to look at it would be, like I said earlier, it's similar to Global Atomic in a lot of ways. You're paying for that excellent management and marketing and share structure and all that, alongside a massive amount of uranium still in the ground after this plan goes through. And in editing, something I completely forgot to mention, DYLL also has ties with Japan, so if Japan comes back online with their massive nuclear arsenal, you can imagine what that means for a company with ties to Japan with a massive deposit. Very good things. Anyways, let's finish up the intro. So overall, of course, the DCF isn't great here, but like I already just said, seems like you're paying a premium for DYLL. I'll put it that way. Anyways, thanks for watching. Hope you guys enjoyed this video, and hopefully I'm back next week. I'll see you guys next time.